Welcome back to the Farms in BC podcast. I'm your host, Nav Seacon, and today we've got a very special guest, Mandeep Tung with Affinity Accountants. Today we're going to be discussing the 2024 proposed federal budget, and we're going to be discussing how this is going to impact business owners and investors. Stay tuned. Welcome, Mandeep.
Hi.
Mandeep, I just want to congratulate you first on your guys' big achievement with merging with another accounting firm. How do you guys feel?
Awesome. I think it's amazing. We're excited. We just merged earlier this year, and we're super excited for it. It just brings so much more breadth of experience. So we're looking forward to working with the bigger team now.
Nice.
Yeah.
Tell me about Affinity Accountants. Tell me your history and when you guys started.
Yeah. So a little bit about myself. I started my accounting career about 20 years ago with a small firm in Surrey. And from there, I moved to a larger firm. I worked with KPMG for several years, where I got my CPA, back then actually Chartered Accountant designation.
That's right, they changed it.
Exactly, right?
Yeah.
So that was in 2008. I got my designation, and in 2016, I started my practice with one of the other partners, Iqbal Shangera.
Yeah.
And we were a full-service accounting firm from the beginning. We just didn't delve too much into audits back then, but now it's, we've got another partner that does a lot of audit work.
So that enhanced the merger.
The practice quite a bit, right? So we've always done tax planning. We've always been quite heavily involved with our clients, and we've always grown organically. We never bought a practice. We just we've grown from just word of mouth, right? So it's been a success story for us, right?
That's right.
So it's now with the merger, we've enhanced our services. We are very involved with our clients, like I mentioned before. We take a big interest in their full family kind of matters, their planning, which allows us to not just focus on just tax filings.
Yeah, so you guys probably do their personal, their corporate tax planning?
Exactly.
Estate planning?
Exactly. Any corporate structures, we'll look at them. We'll review corporate structures, see if this is actually working efficiently for them.
Yeah.
As parents want to retire and the next generation wants to come in, we sort of review that. How do we make this happen?
Yeah, I've talked a lot about that on my previous podcast, just with this whole new wealth generational transfer. Accountants are going to be busy, and we advise a lot of our clients, hey, do some planning, figure out a full structured plan with your kids and a professional accountant. And I think that's going to be a big gap where you're going to see a lot of these baby boomers go in and start doing a lot of these plannings.
For sure. And honestly, we see this in our community. They kind of leave this to the very end.
Yeah, we've
right?
talked about that. Yeah.
So it is something that we need to kind of push them into sometimes. And it's the younger generation that's usually approaching us, saying, okay, help us out. Make our parents understand this in like simple terms, and make them understand what are the tax implications when something happens to them. Yeah. Right? So it's fun. It's fun work.
No, I'm very proud of your guys' growth. I know we've done a few things together, and your guys' entire firm have been exceptionally good with your guys' service. So let's dive deep into the federal budget. When I've talked to a lot of colleagues, a lot of business owners, and it's interesting when I ask the question, what was your original thoughts? And I'm getting not the best answers.
A lot of frustration.
Yes.
A lot of,
So what was your first thoughts about the budget when you heard it?
Shocking, right? I mean, there was talks of, capital gains inclusion rate increasing. Historically, they've always talked about it, that this is going to happen. I didn't think it was happening this quickly. Yeah. Right. So that was shocking. And then, it seems like it's such a political play, right, by the Liberals. Yeah. Again, I don't want to, share my political views here, but at the end of the day, what they're doing is they're really promoting that they're taxing the wealthy. Correct. Right? Yeah. Which define wealthy. Yes. What do you define wealthy as, right? Yes. So that is where it's a little bit of a challenge to who are they taxing? Are they taxing all? So they're considering wealthy as someone who has a corporation. Correct. And has any sort of investment in a corporation. Yes. Right?
as you know, they increased the capital gains lifetime exemption. I think that was a good thing. Is there anything positive that you saw out of the budget?
There's a couple of things. I mean, they're really focusing on housing side of things. So anyone who builds, a special rental purpose housing project, there's some incentives there for them. There's also, for some individuals, there's still some incentives like the home buyers plan increase. There's also that's going from 35 to 60, and then there's also the mortgage, the amortization period on the mortgages for first-time home buyers to 30 years. So there's a few things that are good in the budget that will help individuals, that will help certain people. But when it comes to investments and any corporations holding any investments, and we can't assume they're all wealthy.
That's right.
There's people that are working hard, small business owners that may have taken some funds and invested them in a rental property or something within the corporation.
That's right.
And now all of a sudden they're impacted by this, right? Or you may be using a property for your business purposes, right? Say your office space, for example, right? Now when you sell that and say you don't have a replacement property in place, right? And you're selling that unit, all of a sudden you're triggering capital gains, which you're impacted by that. And there's no exemptions, nothing provided to you.
Well, let's get clear. What was the capital gains, like for everyone to just discuss what was the capital gains before and what are they proposed now? Like what is the actual numbers that are?
Sure. So only 50% of the capital gains were always taxed. And this has been in place since 2000, right? So the inclusion rate, so 50% of capital gains would be taxed at your marginal tax bracket.
So let's use $1 million.
Right? So $1 million, right? So again, corporations are taxed differently than individuals, right? So for a corporation, so say you had $1 million of only 50% would be taxed.
So 500.
Yeah, 500,000 would be taxed of the capital gains would be taxed, and they would be taxed at say about 50% rate.
So let's give the audience an average tax bill for $1 million.
So it would be around 25% would be your tax bill.
So about 250,000.
Exactly, right? So now you're going to be taxed at about 32 to 33% range, and it's going to be close. It's an 8% jump.
Yeah.
And
so on $1 million, you're looking at
80 grand difference.
80 grand difference.
Yeah. So 80 grand difference.
So that's on the corporate side or personal?
On the corporate side, that's how much additional tax you would have.
What about on the personal side?
So on the personal side, that they've said that they'll give you an exemption of $250,000. Not an exemption, I shouldn't say exemption, but the inclusion rate will not change for the first $250,000.
Yes.
So the first $250,000 will be taxed at the 50% rate.
Okay.
And then after that, it will be taxed higher.
Okay, right. So that could be real property, that could be corporations, that could be any business, anything that's related to personal entity.
Yes, anything you personally hold.
That's
right. So if you hold shares of a corporation that doesn't qualify for any other exemption.
Stocks.
Right? Yeah, exactly. Right. So any kind of investment portfolio that you're managing that you all of a sudden dispose of, you get the $250,000 exemption, and then after that, you have to pay the additional 8%.
Yeah. So we know that these rules are going to be, first off, they're proposed.
Yeah.
Okay. We know that there are a few of the parties that have announced that they're not going to be supporting it. Now it's going to come down to the NDP if they're going to support it or not. And if they do support it, this takes an effect on June 25th, is it?
Yes.
So, okay. So we've got about a month and a half to 2 months, let's say.
Yeah.
What can these people do out there that have real property and personal corporate stocks? Like what can they do with their current assets to try to minimize or not have those capital gains be affected to their assets?
So it's a tough one, right? Because ideally I would say, sell it and trigger the capital gain. But who's ready to pay the tax bill right now, right?
That's right. So
just imagine all the accrued gains that some people have. And the bigger issue that I see here is, for individuals, you get the $250,000, and you can slowly, maybe if you have an investment portfolio, you can plan it and dispose some of it each year, time it well, right? But if you have one rental property,
Yeah.
say you bought for like years ago for 300,000-400,000, today it's worth almost 2 million.
Yeah.
You're not going to do that before June 25th.
No.
You don't have enough time to do that, first off, right?
I was looking a little bit into this. Yeah. Can you explain crystallizing?
Yeah.
So is that one option is just sell it, try to sell this thing before June. Mm-hmm. And again, we don't know if this is going to get adopted and voted in. Mm-hmm. There's still a chance that it might not. And so I've got clients that have called me and said, Nav, should we be selling? Should we lower the price and sell it? And it's so tough for us as professionals to give that advice when we don't know if this is going to even get adopted. Yeah. Right. And it's very tough making these decisions at this time because it's not a few dollars, it's hundreds of thousands of dollars for these clients, right?
It is. And part of the budget is they're expecting about $7 billion of revenue. Yeah. From this.
Immediately.
This year. Yeah. For this year. And
I think the total in the 5-year budget was $19 billion.
Yeah. So a big chunk of it, they're expecting that because they want you to trigger these taxes, right? Trigger these gains and pay those taxes at a lower inclusion rate. Yeah. Right. And you can, if you've got a corporation, you can crystallize those gains by triggering the gains. Yeah. Say you sell and then you rebuy, right? Or you sell and repurchase those investments.
That's right.
Say it's an investment portfolio in a corporation. Yeah. You may do that. Yeah. Right. And you may trigger taxes. Yeah. Right. But it totally depends on each individual. You wouldn't panic sell right now.
No.
Right. So it's something that requires a lot of analysis. This is something that you wouldn't rush into. There's other things that would come into play as well. Like there's alternative minimum tax. There's other things that was, the rules around alternative minimum tax changed beginning of this year. Yeah. So there's other things that come into play. So you cannot panic sell, and you can't even crystallize fully without knowing all there is no, in this proposed budget, there is no draft legislation. So you don't know the finer details.
Oh, so these are high level bullet points that can be modified. There could be other exemptions. There could be. And so for you guys, for your clients that are calling, how are you guys handling this?
It's a little bit of okay. So if you're planning on selling anyways,
yes,
right. That's a discussion. If you are planning on selling anyways, let's do this, and let's see if we can make this happen prior to. Yeah. Right. There's clients that are holding investment. I've got a client that's on his way, like he's retiring, right? He's got a bunch of investments sitting in a corporation and he wanted to pull these out anyways, right? So then it's something like, okay, let's make this happen prior to June 25th, right? You were planning on.
So he's going to do it regardless.
Regardless, right? So versus a person who's just starting, a doctor who's just starting off and he's, this is his nest egg.
His practice, his baby that he grew for the last 20, 30 years, may still want to practice for another 5, 10.
Exactly, right? Yeah. And for him, it doesn't make sense. Yeah. Maybe not. Who's to say they won't change the inclusion rate
for the next election or the next party that comes in? Yeah. Right. So I think that's what I'm also hearing is that, maybe we just don't sell. And maybe we, if you had a horizon of, you were going to hold it for the next 3 to 5, well, then let's ride it out, right?
I could tell you, we could do a bunch of tax planning around it, but then for all you know, they could have these finer details in there where...
It throws the whole thing off.
Exactly, and then there's this thing called GAR, which is like set of rules for anti-avoidance of, like, they don't want you to avoid tax.
Okay.
And they can penalize you heavily if you try to avoid tax.
Yeah.
So if anyone comes up with a plan that's trying to avoid
paying
some sort of tax,
they can penalize you.
If we don't know the details on this, right? So that's the challenge. So as much as they're thinking that, by putting a 2-month deadline, right, they are giving us an opportunity to trigger these taxes. I don't think it works that way.
Yeah.
Historically, I think I was reading up on it. Like I think in 1980s they did do this like change in inclusion rates, but they had proposed it. So normally what would happen is either they make it effective today. Right, so that's what they should have done.
Yes.
Effective today, it's the rate is X, right?
Yes.
So now we're going to say effective today, it's 2/3.
It is what it is, yeah.
Right. Yeah. But instead of that, giving us that 2-month period, historically, what they've done is starting next year. So that gives you a lot more time. So you have a 1-year window to plan. Right? So if you're planning on selling a property,
you've got a year window.
Yeah, exactly. To plan it, sell it properly, and not panic sell. Right. So that's the difference here, where we're feeling like this is not enough time, and I'm not advising my clients go sell everything.
Yeah, and I think you just have to take it case by case.
Exactly.
You know, it's interesting. Earlier we were talking about this is considered taxing the wealthy. It's also looked as like, you know, from what I'm feeling is that we're just taxing anybody that was willing to take any risk for investment to grow the economy. It's kind of how I was feeling. Now, what is, like you said, what is considered wealthy? I feel it's not the wealthy that they're targeting, it's the middle class that they're going to be targeting.
For sure. And there's one thing that not many people are focusing on is death. Death triggers capital gains. So
we know, like I've talked about it on my last podcast, we've been getting a lot of inquiries for estate sales. You can't plan that, and if you're selling past June, you're going to be hit with those types of gains.
Exactly. So as soon as a person passes away, the last surviving spouse.
So would that be even on their principal residence?
So not principal residence.
So like a mother or father's?
Yeah, so mother-father situation, they have a principal residence. The principal residence will be exempt from tax.
But any other real estate holdings?
But say this lady had a rental property or a vacation home.
Yes.
Right? So that vacation home, all of a sudden, there's a deemed disposition, and the tax is going to be at a 66%.
But if it was an Airbnb, they would have had to sell it before May 1st. But yeah, I understand. I'm looking out there, and you know, when I was reviewing the rules, I was thinking about, I'm like, okay, who's going to be triggered with capital gains? It's not going to be the private equity companies that are high net worth. It's going to be your plumbing company. It's going to be your any construction, everybody that owns a company. And now, so whoever was planning retirement for the, like, say either this or say next year or the year after, they might just have to push that off for another 2 years, hoping the fact that the next party will reverse it, which is not a guarantee either.
No one's really speaking too much. The other parties are not really saying, okay, we're gonna, we will
reverse it.
Yeah, exactly, right?
Well, I think those discussions and views will start right when the campaign trail starts, and they've got a time of when election is. That's all going to come out.
I think so. The biggest thing for Justin's trying to win all the younger vote by pushing, like, okay, that's who they need all the support. We need to we're going to achieve our objective of taxing the wealthy by introducing this. I don't think it fully does that. I think we're going to end up capturing a lot of the middle class.
Yeah. Well, when they do, say if this does come in effect, like, what do you foresee that's going to happen with investment, the economy?
It's tough to say, right? I do feel like, okay, well, in a corporation, when we get that question, like, okay, should we be buying? You're going to be a little bit careful investing in things, right? Like, you're going to deter investment, right? So they say, like, whatever you tax, what you want to deter, right? So by taxing investments, you're going to deter investments.
Correct.
Right? To some degree, there's going to be some
pushback.
Yeah, exactly.
Or holdback.
Yeah. People are going to be a little bit like, well, the tax impact of this is going to be X, right? So why do this?
Or so the seller might just say, well, why sell? So there'll be less stuff on the market to sell.
Hold off.
Yeah.
Right?
But I can also see the reverse. I can see that, say somebody is desperate to sell. You can see these buyers, they might come in as an opportunity as well, right? But new innovation, having your business in Canada versus the U.S., having manufacturing in U.S., Mexico versus Canada.
It deters other businesses to entering.
And I think it's not the small middle class businesses that we're really deterring. It's the big corporations that create thousands of jobs that we're just pushing them away. So when I look at this, I say, well, where does job growth come from? We've got massive population. We've got a lot of immigration, which we need, but they all need work. They all need housing. We all need food. We all need clothing. And without jobs and without future growth, why would companies, or why would even someone that's coming to live here, why would they choose Canada? Right?
It makes it quite like our tax rate. Taxes are really high
That's right.
now.
And cost of living.
Cost of living. So when you're thinking about cost of living, your top bracket, yes, it's at 250,000, but 250,000 of income, it's at 53% tax rate.
That's right.
Right. So even that's just the normal tax rate. So that cost of living, you need a pretty high level of income to make it happen, and half of it's going to the government, right? So there is a lot of frustration around it.
Yeah, and I think I've been following my quote unquote migration from all these provinces to Alberta. Cost of living, even though they're still paying not as much tax as BC and Ontario, they do have a lot of. It is cheaper living. Aside from the weather. It has all the pluses,
there's
right?
some benefits there, for
definitely.
sure.
Yeah, so capital gains overall, just a summary, it's going to be interesting to see how it plays out. I would definitely love to get you back on, say, after the federal budget gets announced, and let's really see how they're going to change these things. So we also mentioned something that was the lifetime capital gains exemption. Now, previously, it was about $1 million. Now, most of our audiences are acreage farm owners, and $1 million capital gains lifetime exemption. So they've now bumped that up to 1.25, is it?
1.25.
1.25. Is there any other stipulations that come with that?
No, there's no stipulations. It's the same criteria. So if you own shares of a private corporation, small business corporation, right? So it has to be a Canadian corp, and there's a full criteria on it, or a qualified farm property. You're entitled to this $1 million, and they've slowly increased this amount over the last decade. Right now, it's increased to 1.25 million. And the same set of rules apply. Right, when you sell shares of the qualified small business corporation, you're entitled to this capital gains exemption of 1.25 million.
Even individuals?
Individuals. So this is actually just
individuals. What about corporations?
No, it's not a corporate benefit.
It's an individual
benefit. It's always been an individual benefit. So it carries on. It's just the limit is now higher, and then people do have it set up through a family trust where you have a bunch of beneficiaries listed
that can trigger.
Each one of them can get this exemption. So it gets multiplied by the number of beneficiaries.
I know this because we've done it through our family. Well, with farming, you have to be farming. The individuals that are going to be put on, they have to be farming. They have to have a farm income. And then also, I think even after they put on, you have to farm for 2 years, 3 years. I think it's 3 years. I think it's 3 years. So it's that is a plus. I don't know if it's going to offset the farm value of someone selling. It's not going to be enough.
No. I don't think it makes a difference. Right?
At the
end of the day, reality is your farms are probably worth more. Right? So the idea is that this is it's not going to make you sell. It just is a benefit when you do sell.
Additional.
Exactly. Right.
And I think that I've also read that they're going to be increasing it based on inflation
each year.
Okay. So that's what, anywhere between 2 to 3, 4%, give or take.
Indexed, and then they'll just keep increasing it. And then on top of that was that other Canadian entrepreneurs incentive.
Okay.
Right. Which is very similar to, it's funny, it's very similar to lifetime capital gains exemption. So it applies to individuals. But the criteria is so narrow, where it only applies to certain industries, and you phase into it. And it's not an exemption. It is an incentive in the sense that you get a lower inclusion rate when you sell. So your inclusion rate is 50% of what you would be otherwise. So it's actually 33% taxable.
So give me an example. Who would be eligible for that? So
there's so many industries that it doesn't apply to.
When I was looking at that as well, it doesn't make any sense.
It doesn't apply to you. It doesn't apply to me.
I know,
right? And I feel like I'm an entrepreneur, right? So it doesn't apply to me.
So anything services related.
Any professional services. If you have a corporation that is built on your brand, and it's that's where the
Like
value
a personal
is.
brand.
Yeah, personal brand.
Yeah.
Then it doesn't apply to you.
Okay.
Apparently, foods and arts industry, entertainment industry, it doesn't apply to. So
what's left?
I know it's a tough one. I don't know
Yeah.
exactly where, but it's very narrow. So I don't see a lot of people taking advantage of it.
Manufacturing.
Yeah, yes. So it could apply
Yeah.
there, right?
Innovation.
Innovation, tech,
Yeah,
right?
tech, yeah.
So certain areas it would apply to, but
It's probably more for the tech. They just gave billions of dollars to Honda EV for their expansion.
there you go. So
Yeah.
it's triggered towards, and then again, the criteria is that you kind of phase into it.
Yeah.
So over 10 years, you build to that 2 million,
Yeah.
right? And then from that, when you sell, that 2 million will be taxed at 33%. Only 33% will be taxable.
Wow.
Of that gain.
Yeah, it's a I'm
benefit.
hoping they may modify, open
Yeah.
that up a little bit,
Yeah.
knowing the fact that it was maybe too strict and just like not that many people are going to be eligible for it.
But you know what? Funny enough, like even lifetime capital gains exemption or this benefit, there's a lot of people that don't qualify for these just because like doctors will complain. They don't sell their practice necessarily. Sometimes they're just practicing out of a medical corp.
Yeah.
They're not necessarily selling shares of that
Corp.
medical corp.
Yeah.
So there's so many people that don't really qualify for some of these exemptions or incentives anyways. So to them, this whole, building their investment portfolio in a corporation and being taxed with a lower inclusion rate was a big deal.
Yeah.
So you see a lot of, uproar about all of this, that big change is impacting a lot.
Well, that was their retirement.
Yeah, that was. Right?
Yeah.
So it's like to them, they're not getting any other incentive.
That's right.
Yeah.
And then I've also noticed that, CRA, they've got more power to do more aggressive audits, is it? Or they've got more say on what they can audit? Or
No,
what
it's
was that
actually more
exactly?
just the audit process, right?
Okay.
So it used to be that they would have to get the court involved. If they say you had a taxpayer who was not complying, right? So when CRA is sending out, audit.
I've been audited.
Yeah. So say you weren't complying,
Yeah.
right? And historically, what they would have to do is get the court involved.
Okay.
So they would have to go to court, get this order of non-compliance, and then,
get a judgment.
yeah, right, and then go back to court and get the, that's how they would get the penalty in place, right?
Yeah.
Now, that's not the case. They are allowed to do this themselves, right?
Wow.
Where they're proposing that
Self-governance.
pretty much. So they can come in and they can just basically say, well, you're not complying. We're going to assess this penalty,
Yeah.
right? And the penalty is $50 a day up to $25,000.
Yeah.
And the penalty for you not complying, and then they'll leave the reassessment period open till you start to comply.
And you can still have your legal appeal.
Yeah, you can still go through the process.
But they've eliminated that step.
Exactly. If you're not complying, they have a little bit more power. And this is just proposed, right? So this is just proposed. So yeah.
Wow. You know what? No one's talking about that.
A
little thing on the side,
yeah.
a fine print.
Yeah, pretty much. Yeah.
They made some incentives for home builders. Home builders for purpose-built rentals. What are some of the?
It's basically if you're building for the purpose of long-term rental, they're providing additional $15 billion in funding for apartment construction loans.
Yeah.
Which if you're building apartments, and there's a criteria on this as well, like it has to be more than 5 units. It has to be long-term rental. Built unit, basically apartments that you're building for long-term rental.
So is this aside from CMHC, or is this?
This is
the add-on to.
Basically, they're providing more funding towards that.
Okay.
Right.
Yeah.
And the amortization period on those loans is quite high too. It's like 50 years. Right.
Yeah.
So it's a good benefit.
Good incentive.
If people can get that funding.
Yeah.
Right. If it gets a little bit easier to access that funding, it will, improve the whole housing situation. People can actually get into this.
Well, a lot of people, the pre-sales is tough. I think, and I think a lot of these bigger companies are like funds are looking to build these apartments for rental. So if they can be government incentivized to do it with longer amortization, lower payments, it's definitely an added benefit to get housing started and boomed again.
The issue is going to be just how do we do the construction? We need labor. We need all of the other issues that we have with the. But apart from that, I mean, when it comes to having this incentive, at least the funding will be provided.
Yeah.
And then the other thing, you may have heard of the GST on any of these units. Normally, what happens is when you build a building, and as soon as the builder's done building,
they have to charge GST.
They have to self-assess GST because it's for rental unit purposes, right? So they have to self-assess GST, and that can be a hefty bill at times, right?
Yeah.
So this was last November, I believe they.
That's right, they did.
Yeah. So that was a benefit, right? So there's that. But in this budget, they also said that the amortization that you get to claim on these buildings. So normally a building you can amortize 4% only.
Okay.
Going forward, I think it's starting 2025 onwards, it's going to be 10% amortization, which is a big benefit because now you're able to write off that building a lot faster, and you don't have to. It's a huge tax benefit. Right? Yeah.
So I'm starting to see a lot more rental buildings go up. I think the municipalities are fast tracking rental buildings. They're giving more density for rental buildings. It's needed. And I think the way the future is going, just with cost of living, they have no choice. Rental is going to be in big demand for quite some time. What are we, 4 million behind in housing just to catch up across Canada? That is a big gap. Yeah.
Exactly. But again, it comes down to who's investing in this. You could treat these housing units for resale, they would be inventory.
Yeah.
Versus capital gains on this building that you've built, right?
Yeah.
So if you want those investors, the inclusion rate does kind of play into that as well, right? Yeah. So now you have this project, in case you ever sell this building, you're going to trigger capital gains. It's no longer inventory.
Or they build it, get the funding, wait till the government changes. Hopefully they change it back and then sell it. But it's I've said this before too. The real estate landscape is going to be completely different for realtors themselves, builders, the finance industry. The next 5 years are going to look totally different. It's not what we have been used to for the last 5-10 years. It's going to be a big change. And it's going to be interesting to see how it folds. But I do believe that even if they roll it out, I do see them making minor changes
to the budget. For sure. They would have to, I think, right? There's a lot of opposition, right? And at the end of the day, you cannot let your taxes dictate your business decisions, right? Or you have to, you're going to be a business owner, you're going to make your business decisions, and taxes are a part of it, but reality is you're not going to panic, you're not going to rush just to, you got to make sound decisions, business decisions. Right?
Those are good final thoughts. But for our listeners and viewers, if they had any questions or if they wanted to get a hold of you, what's the best contact information that you could provide for them?
So they can reach me at 604-364-9060 or at my email, which is Mandeep, MANDEEP @AFFCPA.ca.
Nice. Thank you for coming.
You're welcome. Thanks for having me.
Yeah.